Have you ever wondered why markets seem more chaotic than ever? Over the course of the last 30 years as an advisor and portfolio manager, I've come across dozens of explanations about how capital markets work and why. Many of these explanations are self-serving and rooted in client acquisition. As a result, I'm naturally skeptical whenever someone comes out with a new narrative about what's going on. I'm John DeGuy, portfolio manager with Design Securities and the host of the Make Better Wealth Decisions podcast. Today, I'm going to tell you about the narrative that strikes me as being plausible. In the autumn of 2024, a fascinating paper was released by Cliff Asness, who is the chairman and CEO of AQR. It offers a unique and often counterintuitive explanation about what's been going on in capital markets lately. Cliff is one of the most respected voices in financial management, and his firm manages billions of dollars. His paper is entitled The Less Efficient Market Hypothesis, which is a cute derivation of the more famous efficient market hypothesis put forward by his friend and mentor, Nobel laureate Eugene Fama. Fama's view is that the price of any security on any given day is more or less fair and reflects all information as it becomes available in real time. Accordingly, the hypothesis suggests that stock picking as it is practiced today is a fool's errand because there are so few meaningful mispricings that can be exploited by even the savviest of industry participants. The paper, which has caused quite a stir among people who like to muse about how to explain market gyrations, suggests that markets have actually become less efficient over the past 15 or 20 or 25 or 30 years. In other words, mispricings are more likely to occur today than in 1994. According to Asness, the increased prevalence of meme stocks and day traders acting on noise rather than conventional data has caused prices to be less accurate than they were a generation or more ago. The first observation, therefore, is that markets may be becoming riskier than they were previously. More concerning, however, is the fear that buying and selling meme stocks based on herd behavior and groupthink could cause financial bubbles to form more easily and to persist for longer than they otherwise might. A number of people, me included, have been perplexed by the persistence of lofty valuations in markets in general and in the U.S. stock market in particular. The cyclically adjusted price-earnings ratio for the S&P 500 has been in the mid-30s or higher for the past 2 years. Other than a brief period during the dot-com bubble at the turn of the millennium, valuations have never been this high. For context, the cyclically adjusted price-earnings ratio for the S&P 500 was around 30 when the Great Depression started in October of 1929. Stock markets in general are expensive, and in the United States, the large cap market has almost no precedent for its current valuation. It is currently trading at a level that is more expensive than it has been about 98% of the time throughout recorded history. There's an old saying in personal finance that markets can remain irrational for longer than you can remain solvent. I'll even go so far as to admit that I became concerned about valuations in late 2019, 5 years ago, before any of us even heard the word COVID. While there have been a couple of drawdowns since I became concerned, the U.S. market has proven to be remarkably resilient over the past 5 years or so. Nobody can reliably predict when markets will peak, how far they will drop, or how long it will take for them to regain their previous highs. That being said, there are a number of people, again, including me, who have taken steps to reduce the exposure to stocks in general and to U.S. stocks in particular. A similar way of expressing the same concern is by looking at the so-called Buffett indicator, named after legendary investor Warren Buffett. The ratio is derived by dividing the entire market of the United States stock market by the country's gross domestic product. As of the most recent reading, the ratio is over 200%, which once again places it around the 98th percentile of historical valuations. The concern is that if the stock market is growing faster than the actual economy, it may indicate the formation of a bubble. Buffett has been quoted as saying the ratio is the best single measure of where valuations stand at any given moment. And as I record this in November of 2024, there's a real sense that we could be in for some rough seas ahead. No one knows. But to the greatest extent possible, we should all consider doing what we can to take risk off the table. Buffett himself has a large cash position.